Gold has been a store of value for thousands of years, but in the modern financial world, it trades as XAU/USD, pairing physical gold against the US dollar. Unlike stocks or bonds, gold doesn't generate cash flow or dividends. Its value comes purely from perception and market sentiment. That's why its price is so closely watched by central banks, institutional investors, and retail traders alike, making it one of the most liquid commodities in the forex market. The most fundamental driver of gold's price is its role as a safe haven. When geopolitical tensions rise, wars break out, or pandemics hit, investors rush to gold because it's tangible and has historically held its value when paper currencies falter. This flight to safety creates sharp and sometimes violent price spikes, especially during moments of uncertainty when traditional equity markets are bleeding. You'll often see gold and the stock market move in opposite directions, a clear sign of its defensive nature. Beyond fear, gold is the ultimate inflation hedge. When central banks print money or governments run large deficits, the purchasing power of fiat currency erodes. Gold, being finite, tends to rise in response. CPI data releases, wage growth, and energy prices all feed into gold's longer-term trend. Traders watch these numbers closely because a surprise jump in inflation almost guarantees a bullish move in XAU/USD, while disinflationary or deflationary periods typically weigh on the metal. Now, the dollar factor is crucial. Since gold is priced in dollars, any change in the dollar's strength directly impacts the pair. When the Federal Reserve hikes interest rates, the dollar strengthens, and gold usually weakens because holding the metal yields nothing compared to interest-bearing assets. Conversely, when the Fed cuts rates or signals a dovish stance, the dollar drops, and gold rallies. So every FOMC meeting, every minute of Jerome Powell's speech, and every non-farm payrolls number becomes a trigger for XAU/USD volatility. Technical traders love gold because it follows clear chart patterns. Key support and resistance levels on XAU/USD often hold for years, and the pair tends to react to psychological round numbers like 2000 or 2500. Moving averages, Fibonacci retracements, and trend lines all work exceptionally well on gold's daily and hourly charts. Yet, it's also prone to sudden breakout moves after prolonged consolidation, which means a disciplined trading plan with strict stop losses is absolutely essential. But daily trading requires volume and liquidity, and gold delivers. The London and New York sessions overlap is when most of the action happens, producing some of the cleanest trends and highest volatility. During Asian hours, however, gold often trades sideways, so many professional traders avoid it or use scalp strategies. Slippage tends to widen during news events, so you need to watch economic calendars to avoid getting caught on the wrong side of a fast-moving spike. One common mistake traders make with XAU/USD is treating it like a currency pair when it behaves more like a commodity index. Gold's reaction to economic data isn't always linear. Sometimes bad news for the dollar is bad news for gold if it signals a global liquidity crunch. That's why correlation with other assets, such as silver and copper, matters too. When gold and silver rally together, it confirms broad commodity strength, but if silver lags, the gold rally might be fragile. In the end, successful gold trading is about respecting its dual nature, a store of value and a speculative instrument. The same chart that moves on inflation data can shift on a single tweet from a head of state. You have to manage risk aggressively, size positions carefully, and never over-leverage, because gold's volatility can wipe out an account in minutes. With the right mindset, however, XAU/USD offers endless opportunities for those who learn to read its unique rhythm.